I find it a little difficult to talk about markets with you because we always have the same view. Very often, now I have to try to play devil's advocate and put myself in other people's shoes. Let's start with valuations. You manage a series of funds. I manage a series of portfolios. Both of us don't tend to buy extremely expensive stocks, which are the ones that are pulling the whole market, Nvidia, Microsoft, and so on and so forth. Why? Why don't you buy them?
In the case of Nvidia, when you're a manager, you have a very hard time buying a stock that today stands at 70 times EBITDA, knowing that just in 2015 you could pay the same company 7 times and nobody even wanted it. From a certain point of view, it is difficult from an emotional point of view to say, gee, I didn't take it at that time because it was so cheap, because I hadn't seen certain things that even in a certain way you didn't see. And today, with the explosion of artificial intelligence, you realize that there is a gigantic market that, however, none of us are able to define and delimit properly. This is the reason why the 70 times EBITDA could be a high number or even a low number. That is a high number, because it will turn out later that maybe in 5 or 6 years, the addressable market that analysts are giving us is much bigger than what will be realized, or we will have the opposite effect, that it will be a much bigger market. However, today paying 70 times EBITDA means assume that there will be no competitors, so that their product will be the dominant product for the next 10 years. And the marginality will always remain the same. Actually, these are somewhat forced situation, in my opinion.
Because the bigger the company gets, the more it tends to struggle to take market share, because if you've already taken it, the more competitors come in, and then the whole age margin tends to go down.
You have little room to make a mistake that could be huge, because not only you do not have the ability to define how much the addressable market is with a precise number, but because of the fact that it is a new market, you don't even have an idea how fast you are going to get to that market. So today, when you pay such a high multiple, whether the company grows at 20% or 25% makes a difference. Let's take the effect of interest rates, for example, changing the assumptions in a model, raising or lowering interest rates, you change significantly the valuation. And the same thing with growth, changing the growth, you change the valuation dramatically. Today, this stock is discounting such a good scenario that any entry into the market by a competitor can make the optimal scenario quite different. I can't buy these stocks because I think about the downside, I think about the risk we are taking.
So let's talk about the market in general, because today, taken out of Nvidia, the S&P trades at
almost 21 times earnings.
From 21 times earnings compared 10 years ago to 15 years ago. This whole part of valuations has moved upwards. So the question here is, don't you think that investor psychology also has something to do with valuation? That is, don't you think that today maybe we assume that it's okay to pay 21 times earnings because a big chunk of the market is made up of companies that are generating more cash than what they could do maybe 20 years ago, that have higher margins than they did 20 years ago. And anyway, that in general, the balance sheets and income statements are better than they were 20 years ago.
I think there are two distinctions to be made. The first is that you have to take into account what the interest rate levels are. It is true that today we are paying 21 times the standard and as well, so the earnings of the S&P, however, in an environment of higher rates than 2 years ago. So the effect of raising rates should have resulted in a decrease in multiples that we didn't have today. Then you have some economists saying, okay, we've had an economic slowdown, which is then actually true or not true, but we've had an economic slowdown, a reduction in the manufacturing cycle, so there will be a reacceleration of growth when the Fed lowers rates. And so the multiple already takes into account the fact that earnings will go up in the next few months. There's already a question mark here because it's been 2 years, in fact, that earnings have not gone up. The other thing is the one that we have often and willingly talked about, which is the fact that today's companies, it is true that they are more profitable than they used to be, but only some companies are much more profitable than they used to be, which are those FAANG companies. So the Meta, Facebook, Apple, Microsoft, that have had that good fortune to be in a market with explosive growth where they are the only ones that give these kinds of products. So they have a very high marginality also because their business model has a very low capital intensity. However, if you go to strip out the free cash flow margins of these companies, so from the S&P you go to strip out the free cash flow margins of these companies, you realize that yes, the margins have gone up, but they are not that much different from what they have been in the last 40 years, i.e. There have been up and down cycles, but we are slightly higher than the historical average, but it has not changed that much. Just one thing has really changed since 2001 when China entered the WTO. China has become the tertiarist of the world, so a huge part of that investment that American companies were making for investment in machinery, capex in general, that investment has been made by China, and so Western companies have become lighter from the point of view of assets that they have on their balance sheet, so even for them the marginality has gone up slightly. However, we are not talking about a momentous change. And that is why the margins have gotten higher, so they warrant a slightly higher multiple. However, rates have gone back up, and so the market should have a more reasonable multiple than, again, the debate here is very easy in my opinion, in the sense that there is a theoretical multiple that you can calculate, which is nothing but a relationship that there is between interest rates and how much you expect to have as extra gain to take from investing in equities versus investing in bonds, which is called the equities risk premium. So the equities risk premium historically has been between 3 and 3.5 above the risk-free rate. Today we have a risk-free at 4. So a 3.5 means having an expected return of 8%. This can be translated into a multiple. Today, a multiple with a 4 plus 3.5, so 7.5, means to have a PE, so a multiple of earnings around 15. We are at 21, so either the multiple goes up or the rates go down. So we are in this condition, that is, the economy is doing well. However, it is not accelerating. Earnings have not been growing for 2 years. The multiple is high. We are in a somewhat difficult condition.
We talked about and mentioned China. In my opinion, right now, it's an extremely interesting topic because you've certainly seen as well in recent days, or rather in recent months, China has entered a phase of deflation, definitely against the tide compared to the rest of the world. It is clear that, as you were saying, China being in deflation helps the world to fight inflation. However, domestically it is a big problem. How do you explain it? I have a few points explaining why China is in deflation, but clearly I want to hear, first of all, your opinion on that.
The thing that you have to analyze, by the way, we have an historical reference of what China is today compared to other cases in the past. The most recent case that we have is the 2007-2008 real estate crisis in the United States that can serve as a bit of a reference, or even the case of Japan in the late 80s and early 90s. there was an explosion of the real estate market that arrived at absurd valuations in China, because there was a time when the multiple of houses to income, so the ratio of price per square meter to income, was almost the highest in history, apart from the Japanese case. So certainly there are similarities, and what we know is that when there is a real estate crisis of this magnitude, dealing with a rigid banking system and with a parabanking system, as in China, that is also very rigid, the time to recover, to get the system back on its feet, is very long and involves big sacrifices from a price decline point of view and the impact on consumption.
It is the typical budget recession at the private level.
Right? Exactly, because do not forget that I think it's more than 70% of Chinese household savings is invested in real estate. So real estate, which is the first form of savings in China, goes down. Clearly it has significant repercussions. I invested in real estate. Real estate has stopped growing. It even goes down. It has an impact on how I feel now compared to how I felt before, and it has an impact on consumption. A few years ago, do not forget that China's program, China's long-term program, was to stimulate
the control of domestic consumption.
But consumption is going back, so you have such an effect.
It's a virtuous circle. You get into this view of reducing your debt. So instead of taking on new credit, you reduce your debt, you spend less, asset prices go down, and you therefore continue to reduce your debt, and the whole thing continues to go on like this.
It is the classic paradox of saving. If I do it, it is a virtuous activity. If everybody does it, it is a problem. The only way to get out of this situation is the way the US did during the COVID, to actually give helicopter money, so windfall money, which helped everybody, or as Japan did lately.
By the way, in China, they don't do it because they're afraid to re-stimulate the real estate part. So what they did recently, they stimulated it by lowering interest rates, which, however, it can't do any good. Because when a private individual is focused on reducing debt, you can lower his rate as much as you want, but he doesn't take any new debt. Instead, they stimulated the production part, so that companies produced more, so the supply increased, but not having consumption. They ended up with the companies having to reduce the price in order to get the demand to come back up. And it brought the whole nation into deflation.
This has an impact obviously on the international markets, because China, being a big exporter, obviously exports deflation, which for a certain point of view, in my opinion, is good at the beginning, because in the Western world we are experiencing a period of much higher inflation than what is the desire of the central banks. It will certainly help us, but it may even become dangerous. Let me explain. To Germany, China is the first trading partner. German automakers sell 20% to a third of their production in China, so you have the effect that consumption goes down in a way that is maybe less important for the car part, because it will hit a wealthy consumer, but the impact is there. So you export deflation, which at first may be okay, but after a certain level it may even go to hit your margins at home. However, speaking precisely of Germany, we have a second problem. Germany is facing a weak international market, such as China's. An energy transition that they have not prepared for.
Not only they have not prepared adequately, but they've made a series of unbelievable mistakes in the last 6-7 years, from nuclear disposal to a whole series of things.
So about energy, they are in a difficult position because Germany's energy cost is among the worst in the world. Production costs are very high, and put the transition of the electrification of the fleet, they are at a disadvantaged position compared to China. So the European economy, Germany being the engine of Europe, we are facing years in which Europe will grow below its potential, so considering the long run, it can give us a lot of problems also from the social point of view, because if an economy does not grow to its potential, this obviously leads to repercussions on the labor market and also on the social level. But staying purely on the economic side, certainly Europe is an interesting reference market for us who do this work, because finally we have rates at interesting levels. Multiples on equity are not that high, but we lack growth. That's right, it's a market that doesn't grow.
So what are we going to do? We don't buy it?
Actually, the behavior of the European market is very rational, because a lot of those stocks in Europe that have some growth are doing very well. VMH, which is luxury par excellence, SAP, which is technology, STM, which is technology, Novo Nordisk with medicine for the treatment of diabetes.
Paradoxically, it is not sold in Europe, it is sold only in the United States.
Another funny thing is that the biggest medicine that is supposed to treat obesity actually will not be sold in Europe because of the intestinal risks. So Novo Nordisk actually grows, maybe because it grows out of Europe.
Novo Nordisk's target is 80% of the American population. It is potentially the most successful medicine in the world.
In history,
by the numbers,
the two companies, Eli Lilly and Novo Nordisk, actually find themselves with a market that has never been larger in the history of pharma. Then let's leave aside the various arguments that can be made about whether or not these Band-Aids should have been either yes or not approved. There are very important side effects, however. The certain thing is that in America, in the next few years, 30% tending to 50% of kids and teenagers will be in pre-diabetic condition. 60% of the non-teen population is already obese or diabetic. The pre-diabetics condition is around 80%, as you were saying. So in fact, this medicine is made to treat almost 300 million people.
How long does a patent usually last? 10 years, right?
Patents are de facto. Then by changing some small molecule, you extend these expirations again. So from an equity investor's point of view, de facto, it's like infinite.
Going back to Germany, in an environment where we don't grow, paradoxically, the Germans, who used to be the locomotive of Europe in terms of growth, are now a little bit the handbrake. If we want to keep this idea, they also are the same ones who are a little bit against powerful stimulus. At this time, maybe we would need to lower interest rates even quickly, despite an inflation that is going down, but it's not going down as fast as we would like to believe. They are the ones holding the handbrake. How do you think we can get out of such a situation? Let's change the political class.
This is hard to say, because the only thing we can say now with what we know is that the ECB will be the first to cut rates in good likelihood in April. I was talking to an economist today who says precisely that the ECB will in good likelihood anticipate the Fed by a month. So with an earlier rate cut,
here we are disagreeing. In my opinion, they will cut them this summer because they have to wait for wage growth to come back to a decent level, which it hasn't come back yet, and that's estimated to happen only around May, June, so there will be lag between the figure and the European Central Bank meeting, so maybe they only cut rates this summer.
It is possible in America. They have already told us that March won't be the case. It will probably be May or June. The problem I'm in right now is that if we look at real rates, we have Fed funds at 5.5 and inflation coming down also rapidly. There are all those considerations that we've made so many times before about inflation coming from rents, how they're calculated and so on. So there's a very rapid return of inflation, which means that at stable Fed funds at 5.5 and inflation coming back, real rates will continue to go up, and we know that real rates are a choke on the economy. So banks will continue to not lend money. So inflation-adjusted lending has been negative for several months now. So we're in early February thinking that we're going to get through May with this situation. So there are 3 or 4 months in which monetary policy will bite the economy again. So it's early to sing victory, in my opinion, about having won the cycle, that is, having won the idea that we had at the beginning of the new year that the economy would go into recession.
As the famous inversion of the curve says, which everybody thinks is a magic factor, and in fact there is clearly an underlying economic explanation, which is not very simple, but in fact when the curve inverts, the banks are less profitable in lending, and so they stop lending.
In fact, we have seen that they are not dispersing.
It's too bad that what happened this time is that the US government intervened through extremely large fiscal stimulus. If I'm not mistaken, in 2023, the budget deficit was the largest in a non-recessionary era. So we're talking about a situation we've never seen.
%8 with an employment rate at 3.5% that has never occurred even in wartime.
So for those who say today we are not going to go into recession again, and the inversion of the curve this time was not as predictive as it has always been in the past years, we could say to them, let's wait and see.
That's still not true, because if we look, generally what you look at is the inversion from the curve that is most effective in predicting a recession is the inversion between the 10-year rate and the 3-month rate, not the 10-2 as everybody looks at. It's actually the 10-3. The inversion at 10 years and 3 months had time lags to be verified in the onset of the recession. These time lags went from a low of about 6 months to a high of 17 and 18. So today we're 13 months into the reversal, so it's still early to say that we're out of the risk, because there's a possibility of getting to 17-18, and it's not necessarily the case that this 17-18 won't be beaten, because the fact that there's been a record in the past doesn't mean that it can't be beaten.
Let's see. However, we have some signs of some cracks. If I think even last week, I'm always wrong with the name, but it's the New York Community Bank Corp, which published its own quarterlies as a disaster. Cutting the dividend, the stock lost 25%. The whole sector since then has dropped like 10%. Let's remember, all of this is happening at a time when you have the Fed supporting the whole industry, because at the same time last year we had the crisis of the small medium banks in America. The Fed stepped in and in fact bailed out virtually all of them.
Its emergency ports expire, by the way, on March 11, so until March 11 everything is fine, then we'll see.
So let's say, to summarize a little bit as we wrote in the last market outlook, we could say that although the stock market makes us think that there is no risk, that everything is fine and paying 21 times earnings to S&P or 70 times EBITDA to Nvidia is normal, we say that we suggest some caution right now.
It may be okay if it's okay.
Exactly.
Let's say it doesn't take into account any schisms that might occur in the next few months.